investor doing things on your own? How about someone working with a firm that isn't so responsive or in sync with your investment philosophy? My podcast talks you through all things financial. Look, there's stuff you don't deal with very often, but investments, insurance, and retirement is something we plan for each and every day. This is the PennyWise Financial Podcast, and welcome to the show. Welcome to PennyWise Financial Podcast. This is Constantine here at Monarch Wealth Management with my co-host Sam Gueli. Welcome to the show, everyone. Today is Wednesday, July 6th, just after the 4th of July. How was your weekend, Sam?
It was pretty good. It's pretty long, but a lot of fun. So,
Family,
friends,
Did you see the
all good
fireworks
stuff.
show? What are they? Are you Fairport or
Yeah, they do fireworks, but I didn't see it this year.
no?
Mm.
Okay. Well, that makes two of us because this is like the first year in a while that we did not see a firework display, but my son really could care less.
Yeah.
I mean, we try every year and it's exciting for him for a couple minutes and then he just kind of does his own thing. He's in his own world. Speaking of own world, what the heck is going on with the market now? We're halfway through the year, just past it. So this is the first trading session in the second half of 2022. Why don't you give us some updates on the market?
Yeah. Okay. So starting with the Dow Jones, we're pretty much flat over the past week. And then the month and year to date numbers are pretty much the same at -6 and -15. Going to the S&P, again, pretty much flat. The last month down 6, year to date about down 20. Everything's looking pretty similar. NASDAQ were plus almost 1% over the past week, down 6% over the last month, and almost 30% year to date.
Ouch.
And the Russell 2, same thing. We're flat over the past week, down about 8% over the past month, and still down about 23% year to date.
Jeez. So what you're saying is there's no hope in sight.
I mean, I'm getting sick of talking about all this negative numbers.
A lot of pessimism, right?
Mm-hmm.
6 months in, it certainly is not getting many people too excited to look at their statements. I know a lot of people don't look because they don't want to be afraid of that. But I feel like a lot of people get short-term memory loss and they get tunnel vision. In the last 5, 10, 15 years or so, market has been really kind to us. There's only been a few times where there have been some hiccups, but I think the onset of COVID really kind of woke people up a little bit and said, "Whoa, wow!" But it happened so fast. The road to recovery was so fast that it didn't give people even time to react. And then they got comfortable with it. Okay, yeah, we can withstand losing 20 or 30%, no problem. Well, sure, when it comes back that quick, of course you can. Now, let's shift gears and take a look at some of these sector plays. We first look at the XLE. That's the energy sector. And that ETF year to date is up almost 17%. Now, it was up quite a bit more. What did we say? At one point, it was up maybe 25, 30%. And that peak was really around June 8th. So just about a month ago. And in the last 5 trading days, this thing is down almost 13%. So definitely seeing a reversal in that trend. And today alone, it's down 4%. So that's no joke in the energy sector. Now, oil prices, so that's energy, but oil specifically is now around $90 a barrel. Some of that relief might be coming from the temporary oil reserves that President Biden has opted to open up, but that's a temporary Band-Aid. That's just going to last for a certain time frame. And then the state and the federal proposal for the tax relief on gas, that's helping. And then how about the supply of Russian oil that's being sold to China? So all of these tariffs and whatnot and ramifications that we're trying to impose on Russia is really kind of a moot point. So those are some of the things that are going on with oil. But I'll tell you what. So we talked about 4th of July. I was at the marina almost the whole weekend. And I shared this with you the other day. Remember what I paid a gallon?
Yeah, you said it was like $7, right?
7.09. So they had a big sale on gas, I guess. Guys at the marina laughed. I mean, it's probably one of the busiest weekends for us in upstate New York, mainly because it's kind of the real beginning of the season where our lakes, our Finger Lakes, are starting to warm up, and the weather's starting to look a little bit better, and everybody's off of work. So it was a good time, I think, for them at the marina. We had fun. Weather was decent. Shifting gears, let's look at the financial sector. That is the XLF, and that has not been doing so well. Not faring much different than the major indexes, down about 20% year to date. And in the last week, the XLF, the financial sector, is down about 1.5%. Let's shift gears and look at real estate. That's the XLRE. Year to date is down 19%. And in the last week, it is now up 1.5%. Okay, so I like that trend. Pays a nice, healthy dividend. Real estate has been on fire if you're looking to sell. And if you're looking to buy, you're kind of cringing when you see the prices and then you see mortgage rates. How about gold? We look at the GLD, that's a Spider Gold ETF. Year to date is down 3.5%. And last week, it's down 5%. So strong dollar, not going to have very good impact on the gold. And we can see that in the last 5 trading sessions. Shifting gears to the cryptocurrency, we look at the GBTC, the Grayscale Bitcoin Trust. And that particular trust year to date is down 64%. In the last week, it's down about 5%. We look at Ethereum, that is the ETHE. That's down 76.5% for the year. And the last week, it's up 0.05%. The last cryptocurrency is the Grayscale Litecoin Trust, the LTCN. Year to date, that trust is down 73%. And in the last week, it's down 10%. So there's not many places to find relief. There's no places to really hide. If you're looking at savings accounts, you're probably getting maybe 20 basis points, not even 0.25%. So there's not a lot of places where you can hide out right now. Corporate bond yields are doing okay. If you hold them to maturity, those are some of the things that we do for our clients. But if you own bond funds or ETFs, those can have some troubles, right? And as interest rates rise, it's going to have an impact on those bonds. They're not worth as much. Nothing wrong necessarily with the bond itself. But if I'm able to get a new bond that's paying more, the bond that you had a couple of years ago might not be as valuable. So we're going to be talking more about the market changes and maybe how things might look for the second half of the year later on in the show. With that, let's take a quick break and we'll be right back with the show. Do you want help building and managing an investment portfolio that's right for you? One that will help you maximize growth potential while you're saving, help you generate income when you need it most, and eventually preserve what you've saved to leave to your beneficiaries? We do this day in and day out and take the stress and responsibility of making those decisions off your plate. Subscribe to our newsletter, read our blog post, and listen to our podcast to get a flavor of how we do things. Our firm is unique and capable of handling all your investment and insurance needs. Monarch Wealth Management, our guidance, your future.
Welcome back to the PennyWise Financial Podcast here at Monarch Wealth Management. My name is Sam Gueli, and along with Constantine. Today we're talking about our customers, and they want to know what they should be doing given the current landscape of the market. And we actually got some pretty cool stats and graphs about the mid-year market from, I believe, JP Morgan.
JP Morgan.
That's
right.
And there's a bunch of really cool ones here. And if you take a minute to really get into them and try to understand them, they provide some optimism, if you ask me. And a lot of this stuff is really interesting to me. I know Constantine agrees. And Cons, which one do you want to talk about first?
Well, yeah, let's set the stage for some of the conversations we've been having. Because I'm willing to bet you that not only our existing clients are having these questions, but people who are not current clients might be thinking the same thing, listening to the show. And so a lot of people are questioning their thought process, their goals, and reevaluating things. And they're saying, geez, Cons, Dave, Mark, Diana, am I positioned properly for the next 5, 10, 15 years, whatever their goal might be? Either if they're in retirement, drawing retirement income, or if they're working towards that savings goal. And then we always go back to revisit and just say, has anything changed in your life? So if your goals really haven't changed, the current market conditions shouldn't have a dramatic impact on what you're doing, unless we were investing, in a completely wrong portfolio that was not suited for your needs. So that's kind of the conversations that we've been having. It's second guessing people and saying, geez, I was okay when the market crashed in 2020 with the onset of COVID because it happened for a month or two, and it was back up and then some. So let's start off with the first one. This is a chart that we've looked at before in the past. I know some others we had that went back to 1950. But what is this chart? I know listeners can't see this, but Sam, what does this chart tell us? What is this graph designed to tell us?
It's talking about annual returns and intra-year declines.
So we're looking at going back to 1980, all of the years where the stock market dipped down into a negative territory. In some years, it might end up positive. In some years, it may still be negative. But the reality is, inside of any given year, there could be some pretty dramatic drawdowns in the market. So if we go back to 1980, the stock market, and I say stock market, I mean the S&P 500, throughout the course of that year in 1980 was down 17%, negative 17%, very close to where we are now. Not quite as bad, but how did we end up in that year in 1980?
Positive 26%.
So at the end of the year, positive 26%. So think about that for a minute. Not only did we make up the 17% in losses, but we made an additional 26% in a positive. So you're talking 30, 40%. That's a really, really big swing.
I mean, 43% over the course of the last 6 months is huge.
Massive. And the problem is that these things happen so quick. If you say, I'm going to get out, go to cash, and I'll just jump back in when things are good, do you think you're going to get it right?
No.
I would say no. I mean, if you can get it right, please call us. We'd love to hire you because we need more people like you. And it's tough. Let's be real. It's tough. If I look at some other years, we fast forward time a little bit. Let's look at, I guess this would be like 1987-ish. Market was down 34%. Where did we end that year?
That year was positive 2%.
Positive 2. Again, I mean, you're talking about a 36% swing in 1 year, in 12 months.
I think given what it looks like today, if we end this year at positive 2, I think everybody would be happy.
If we end the year at 0, I'd be thrilled. And then let's, so this doesn't happen every single year. Let's look at maybe 2002. Market was down 34%. Where did we end that year?
Yeah, that year we only ended minus 23%.
Right. So we still made up a little bit of ground. We didn't end on a low point, but that was 1 year. And then we go back to 2009. 2009, we were down 49%. And we ended where? Positive?
Nope. Not even
not
close.
quite.
Negative 38%.
Negative 38%. So that's to give you an idea kind of where we've been. And then year to date, we touched 24% loss for the S&P 500. 24%. We're not quite there. But as of the 30th, where did we end? Where did the S&P 500?
For this year?
For this year.
21, minus 21.
So we're starting that trend of moving more and more positive. Hopefully that 24% was a max loss for this year, but we'll see. Time will tell, right? This doesn't tell the whole story. But despite the average intra-year drop of 14%, the annual returns were positive in 32 of the 42 years, going back to 1980. It's about 40% of the time.
Mm. And can I just add something real quick?
Please.
I'm kind of noticing even some of the years that start pretty negative and end negative still. The next year has an unbelievable positive swing. So if we look at like 2001, 2002, we were down 34% at one point, ended the year still minus 23, but the following year started off down 14% and finished positive 26%.
That's a good point.
And then 2008, obviously everybody knows what happened, down 49% at one point, ended only down 38%. But then the following year, 2009, we were down 28% and actually finished 23% positive.
That's a really good
huge.
point.
And those are 2 years that stick out to me. So that's like, we like to talk about how things are negative and they can finish the year positive. But even if they don't finish the year positive, the next year is crazy.
And it looks like that trend happens for a couple of years after, usually 2 or 3 years. And you look at 34%, 20%, 31%, 27%, 20%. So that's the late 90s. That looks fantastic. And then we see that in the early 2020s as well. So 2019, 2020, 2021, 29%, 16%, and 27%. Now, year to date, 2022 is not good, obviously, but we've got some ground to make up. Good points, though. Yeah, on the negative years where we end negative, the following years tend to be up pretty big. Okay, so how about confidence in the stock market? So if we look at consumer sentiment and how comfortable people feel and how excited people are about the economy, we go back to 1975. 1975, consumer sentiment was less than 60%. The 12 months following that time in 1975, the market was up 22%. If we go to May of 1980, consumer sentiment was down to about 51%. 12 months after, in 1980, the market was up 20%, S&P 500. And there's these periods, and you can see where it dips below, let's say 70% or so, consumer sentiment and confidence and feeling good about the economy. The returns are massive, 15, 20% in the next 12 months. But just the opposite happens when people are feeling good about the economy. So if we look at January 2015, very close to 90+% of consumer sentiment, that index showed a very positive correlation on how the market was doing. In 2015, 12 months after that, market was down 2.7%. What about in February 2020? It was also pretty high. Market was up actually 29%. Now here we are in June of 2022. Where do we stand, Sam?
For the consumer confidence?
What percentage of people right now in this index are feeling very comfortable and excited about the economy?
It's 50% even.
50%. One of the lowest periods we've seen going back to 1971. Now that doesn't necessarily mean that, the next 12 months are going to be fantastic, but it does show there is some evidence that does happen. When people feel very unsure of the economy and of the market.
And even though, like we kind of talked about, the market right now is as bad as it's been in a long time, still only 50% of the people are worried.
That's true.
You'd think it'd be a lot more.
That's true.
But people must know something, and they might know what we are kind of talking about, that there's a very good chance that things are going to bounce back, and they're going to bounce back and be very good.
Well, it's hard to see too, right? What shows on your statements doesn't necessarily reflect what's happening on Main Street in real life. And what happens in real life doesn't necessarily happen and correlate onto your statements. Mm-hmm. So the economy might feel very shaky, right? You go out, you see people not spending so much. You see there's still products when I go out to the store that they don't have a lot of stock of. I think I mentioned this before, Uncle Ben's rice. Uncle Ben's rice, I couldn't get, my son loves the jasmine rice. It's got to be Uncle Ben's though. So I got him Wegmans, not the Bash Wegmans, but we got him the Wegmans. He goes, "What's that?" He recognized the package. I said, "It's jasmine rice." So he tries it and he won't eat it. And that's how picky this kid is about rice. I'm like, come on. And I try, it's a little different, but that he's so particular about, but I couldn't find Uncle Ben's rice for like 2 months at Wegmans. We look and now it's back in stock. All right, shifting gears. Let's go to the equity scenarios, bull and bear and in between. Let's look at some of the bull and bear markets. So if we go back to 1926, we're just looking first at the bull markets. On average, how many months does a bull market last?
51 months.
About 51 months. Mm-hmm. So if we look at the date of the bull market that we're currently in, debatable, March of 2020, our bull return right now is showing 114%. We're 21 months in duration. So maybe about halfway through the average. So when people say, oh, this is a really long bull market, well, yeah, we might have had a couple bull markets leading up to 2020. Look at 2009. It was a 401% rate of return and lasted 131 months. So let's shift gears and look at the bear markets. What's the average duration going back to 1929 in number of months for a bear market?
Yeah, it's only 20 months.
Only 20 months, so much shorter. Less than half of the average months that we see in a bull market.
This chart's cool to me because it's very clear that a bull market, you're going to get way more returns and it's going to last way longer compared to a bear market. They don't last as long and the returns aren't actually as bad.
That's correct. And
It's
I
pretty
think
good
that
comparison.
that is a great point to make about this chart is the fact that the bull returns are longer in duration. So there's more months in an up market. And like you mentioned, the return is much higher. So there's a big difference. 162% is the average bull market return. In a bear market, it's down about 41%. So how about this bear market that we're currently in, starting in January 2022? How many months in are we? We're what, 5-6 months in?
5 months, yep.
5 months in, and we're down about 24. Well, I think that's pulled back a little bit. We're down about 20%, right? So good point to make on that chart. Let's shift gears now to the diversification of the average investor. Let's go back to 2002. So we're looking at almost 20 years of historical returns. Which sectors did the best? Which did the worst? Let's start off with the best. What do you see there, Sam?
The REITs.
So REITs, real estate investment trusts. So real estate averaged over 11%. How about the worst asset class?
Cash.
Cash.
Not really surprised.
Why do we have cash? Well, cash should be there to pay your bills. Cash should be there for emergencies. Cash should be there for purchases, things like houses and cars and college and things like that that you have short-term goals for. If you have more time, that money should not be deployed to cash. You might have a little bit of cash just for buying opportunities, but you definitely don't want to park your money there for 20 years. And I mentioned that when we do 401k enrollment meetings, some clients will say, geez, I'm really conservative. I'd like a cash alternative, a money market. Yeah, a lot of plans do offer that. Is it a parking lot? Yes. Is it a place to be for 20 years? No. And how about in between? What do we see kind of smack dab in the middle? What do we see there for returns?
I'm just looking at the S&P. I'm looking at bonds, even like the small cap and the high yields.
And almost smack dab in the middle, almost, is like a 60-40 split between stocks and bonds. And that is averaged in the last 20 years about 7.4%. You mentioned S&P 500. So if you were just in the stock market, you average about 9.5%. I don't think many people would be too unhappy with a 9+% return in the last 20 years. Again, if we look at things like commodities, again, a place we have not been for our clients in a very, very long time. It's averaged in the last 20 years, 1.8%. Again, it's not a place you want to park your money in for a very long time. It's very cyclical. It ebbs and flows. It comes into favor, goes out of favor. And then homes, 4.2%. Bonds, fixed income, 4.3%. You're looking for more stability, access to principal and income. That's why you go there. But again, a blended portfolio, smack dab in the middle between REITs and emerging markets and just S&P 500 and cash, you're going to get a 60-40 split, 7+% rate of return. Again, diversification. It's not going to help in every single market environment, but over the long haul, it will do just fine. Now, this is the last slide we'll take a look at today, consumer confidence by political affiliation. Really popular one at the dinner table, I'm sure. So if we look at this, this divides Republicans, Democrats, and then takes a total combined of the economic conditions on how people think or rate the economy as being excellent or good. So if we go back, let's just look at some recent years. Let's go back to 2020. Which party there favored the economy and said that we were in a good economic condition
Since 2020?
in 2020.
In 2020 it was the Republicans.
Republicans, and that was a 80+% of Republicans that rated our economic condition as excellent or good. How about on the flip side? How about the Democrats?
Yeah, it was only about 10% of them.
Yeah, so pretty small numbers. So then we fast forward to 2022, and we have just the opposite, don't we?
Yeah, Democrats up to 36% of them, and the Republicans way down to 20%.
And so the interesting thing about that is in 2020, it's about the same percentage of folks who were Democrat rated the economy as good or excellent back then, still think it's good or excellent right now. And Republicans are down to a near low at 20%. I guess it was the lowest in 2009, 2010, 2011, where you had less than 10% of Republicans. And actually, in 2009, about less than 10% of Democrats and Republicans in 2009 agreed that the economy was not in good shape.
I mean, I kind of look at that as, everybody knows, again, what happened in 2008. And maybe everybody was just finally seeing the reality of that situation.
I agree.
Because this chart to me, I'm looking at it covers 3 election days. And it's funny because before the election day in 2009, Republicans were up, Democrats were down, and then it flip-flops after the election because Democrats took over that year. And then in 2017, again, it flip-flopped when the Republicans took over. So it just kind of shows that it's a little biased to me. You just kind of like whatever your party is in power. But again, in 2008, 2009, I think everybody kind of was like, okay, we're actually in a pretty bad situation.
Yes. And to that point, if you look at the period of January 2009 to January 2017, the average rate of return was about 16%. In that time frame in 2009, like you said, in 2017, when you had Democrats in power, they also rated it or ranked it, the economy being good or excellent. Republicans didn't.
Right.
The rate of return was still 16% average rate of return. And then if we shift gears to 2017 through 2021, when we know who was in power, Republicans, the average rate of return was also
Again,
16%.
Yep.
So I guess what this chart is really telling us is regardless of whether there's a Democrat or a Republican in power, we can still make money. We can still be profitable. These are real companies, real stocks that produce goods and services that have real earnings, not like cryptocurrencies, but real earnings where you can invest in these companies and own a fractional share of their profits.
Yeah,
and still make money.
That's a good point, actually, now that I think about it like that. But it is kind of funny just to see the way the different parties rate the economy, even though you're still getting, on average, 16% returns.
Agreed. With that, I think we've taken up a lot of time for this portion of the show. Let's take a quick break and we'll be right back with the show. Do you have a high deductible insurance plan? If so, have you set up your HSA? There's a ton of people who don't know what it is or how it works. Even worse, there aren't many people who can give you advice about how to make the most of these powerful and unique programs. Not many advisors focus on this in their practice, don't understand the mechanics of how they work, or even where to begin helping their clients. Reach out to me, Constantine at Monarch Wealth Management, and I'll guide you through this process and get you on track to make the most of your high deductible plan and your superhuman HSA. Welcome back to PennyWise Financial Podcast. This is Constantine here with Sam Gueli, my co-host today on PennyWise Financial Podcast. And today we are going to take a snapshot on some of the Wall Street Journal's latest and greatest and finest articles. Sam, why don't you start us off with some of the outliers in the market, some of the good, the bad, and the ugly so far year to date?
Yeah, so everybody knows, what the S&P, the NASDAQ, the Dow, everybody knows they're not performing all that well. And Bitcoin is actually doing the worst out of everybody by far. But I'm taking a look at some of the things that we haven't really talked about, like technology stocks down almost 30%. Communication services stocks over 30% in the red.
Ouch.
Financial stocks are down 20%, and there's so much more that are in the declining in value section rather than the rising in value. So we could talk all day about them. You know, the material stocks, industrial stocks, copper, even all down almost 20%. And to me, that like even silver, we're getting up over 15% down. Gold is now down when it had been up, right? But now it's down. So that to me is, you know, it's pretty crazy. A lot of things are, you know, down that we haven't talked about that much. But when you go into things that are rising in value, some of it's surprising to me. Everybody knows, you know, crude oil, natural gas, gasoline, things like that. But what's sticking out to me is soybeans and corn and orange juice all up almost 30%. I didn't even know you like actually track that.
Yeah.
But people don't actually invest in that type of stuff, do they?
They do. And we haven't in the past 10 or 15 years, but I can tell you those are some of the things that we have invested in for some clients. Livestock, corn, grain, wheat, soybeans, that stuff. When you talk about the conflict right now in Ukraine, and again, you don't hear about it that much anymore in the news, it's still happening. It's still happening. It's still real. And that's having an impact on the price of those goods and services, things like that, where they're able to supply it. And especially when you talk about corn, when you reduce the feed and whatnot, and you put that into gasoline to reduce that cost, you have other problems that pop up. So that's a good point. So those were some of the positive areas.
Yeah. And in the negative, like I said, it's all the stocks and bonds. Those are doing the worst. And then it's commodities doing better than everybody by far.
And we've started to see that shift a little bit. And so that's the thing. And we talked about this too, is if you invested in oil futures in the last 20 years, you're not going to be very happy with your returns. It's not a place where you always want to have money deployed. You don't. We don't always invest in those type of in those areas of the market, because 1 or 2 out of 20 years, you're going to make a big return like 50, 60%, but it can decline and evaporate right before your eyes.
So if somebody were to see this coming and invested a good amount of money right before the oil futures started taking off, they'd probably be pretty happy right now.
Yeah, I bet what you'll see there as far as the big winners would be like a hedge fund that took big bets on that. That can go boom or bust. We don't do that with clients. It's kind of a gamble.
Yeah.
And if they hit it big, congratulations, hats off to them. And I hope they're pulling some of that off the table. If not, like we mentioned earlier, I mean, you look at energy is down 5% just today.
Yeah.
It's been on the downward trend, and we'll see. I guess if we've got inflation under control, that could continue to get worse.
So are we going to see things kind of flip-flop where things like these commodities are going to start to decline a little bit, and maybe the stocks and the bonds will come back a little bit?
Good question. I think going 12 months out, the answer to that would be yes. I think that the Fed is going to continue to get a hold on inflation spending, things like that. That coupled with the tax on gas is going to just slow down spending in general. And like I mentioned, boating, $7 a gallon. I'm not going to be cranking that thing on full throttle, tubing every single day with the kids. I'm sure they want to do that, but you know, maybe you just cut back a little bit. That's all. And then what else is going on? So I have an article here in the Journal that talks about McConnell threatening to block the chip bill over a budget plan. So right now, the U.S. is trying to compete with the rest of the world pretty much on chips. And you know right now, everything relies on chips. Intel CEO on the other day was on CNBC talking about it and saying that they hope that we can get a bipartisan agreement on this so that we can pass this bill and allow these chips to go through and be produced here in the U.S., bring down prices and create more supply.
Yeah.
The demand is so high right now.
I saw that even Tesla, like they stopped including features in some of their cars because the chips required just weren't there.
You almost have to.
Yeah.
Otherwise, you're not going to have a product.
And I don't think their prices were going down either.
Not the last time I checked. No, not the last time I checked. Anything else in the Journal that you have on your section there that you wanted to share?
Were we talking about things like flight cancellations and delays and stuff like that?
Yeah. Do you have any trips planned, by the way?
I'm going down to Louisiana in September.
Baton Rouge?
Baton Rouge.
In September.
Mm-hmm.
What day are you flying out on?
Either the 9th or the 10th.
Is it like a weekday or weekend?
The 10th is a Saturday. I
Sa-
think I'll be going down on the 9th or the 8th, actually. So
Okay.
Thursday or Friday.
So weekends tend to be higher in volume, the amount of
Mhm.
people traveling. What airline you flying?
Haven't decided yet.
Oh, okay. So you're not locked in.
Not locked in. Nope.
I'm curious because I've heard some rumblings from people that have flown like the cheaper carriers, like
Mhm.
Frontier and what's it,
Like
Allegiant.
Spirit or stuff
Spirit,
like
yeah.
that. Yeah.
Tons of cancellations. They show up at
Mm.
the airport. Sorry, your flight is delayed. We don't have anything else unless you fly out of a different city. You're going to have to drive there. Then when you come back, there might not be a flight into that air. All kinds of chaos. They don't have the workers.
So my family and I were in Miami. I think it was a few weeks ago now. Yeah, actually it was late May, so almost a month ago, or actually more than a month ago. That's crazy to think about. But yeah, on the way down to Miami, we flew one of the cheaper airlines because it was the only flight that day, and we had
Direct
no
flight?
problems. It wasn't direct. We flew into Atlanta
Okay.
and then to Miami. But on the way back, we flew, I think, American direct flight from Miami to Rochester, and we sat on the plane for almost an hour waiting for our pilot to show up because we didn't have a pilot. We had everybody was ready to go, but nobody to fly the freaking plane, you know? So we sat there for almost an hour waiting for the guy to show up.
Isn't that insane?
It is. And what I've heard is they've had to, these airlines they're running out of pilots because there's either very young pilots or very old pilots, and there's nobody in between because every time that they have to lay people off, they lay the younger ones off. And now you're forced to retire when you're 65 as a pilot because, you know, mental and
Sure.
maybe eyesight things and stuff
Sure.
like that. So now they're seeing all these older guys are aging out and they don't have any experienced like middle of the career pilots that they need. And I think I heard somebody's trying to like open up a flight school for their own airline. Maybe it was like United or somebody like that, but there's definitely a pilot shortage.
And think about this. If they have a shortage and they come out, the airline industry as a whole, and say, hey, we're hiring, now hiring. You say, yeah, I'll take the job. How long before you accepting, going through flight school and training before you're actually flying a plane and helping that company carry passengers?
I mean, it's got to be a long time. Yeah. You need how many hours? About
I don't know how
thousands
many
of
hours.
hours. Like
a lot.
But that's my point. They don't have any of these middle of their career pilots anymore because they had to lay off a lot of pilots and they laid off all the younger ones. So now all they had left was the older ones, and they're, like I said, they're aging out. So there's a issue now.
I got to think that travel is being like the demand for travel is being pent up because people through COVID, you know, there's still a lot of people that are not comfortable like going out and doing things. I find it hard to believe, but there are some people that are kind of sensitive to it. And I think that in the next 6 to 12 months, you're going to have more and more travel. People want to get out. They might be driving. I don't know. I mean, I think there's less people traveling internationally right now. Although you can get some really good deals. The US dollar is so strong right now compared to the euro. If you want to go to Europe right now, probably get
It's
a decent
cheaper.
price.
Wow.
Yeah. I know Dave was looking at flights for Europe. He just came back with the charity with Guardians.
Mm.
And their flights, I mean, when you look at when I traveled just after the World Cup in 2005, I went to Greece and Macedonia. The price that I paid at that time is about the same price as the tickets they found today. That's
Okay.
insane. I mean,
Yeah, that is.
it's almost 20 years later. Prices are the same to fly. You know, when you think of the cost of everything else being so high and gas and fuel.
Yeah. So when the pandemic hit, obviously gas prices went down, right? So a lot of people, because they couldn't fly, they were buying RVs and driving all over the place. I know so many people who have either done that or know other people have done that. And now, if you can't fly, people might want to do the same thing, but the gas prices are insane now. So if you try to fly, you probably can't get a flight. If you try to drive, you're spending crazy amounts of money.
I honestly think it's cheaper to pay for the flight and a rental car than it is to drive the RV and put in the gas.
I'm sure.
Pay tolls.
I'm sure.
Plus the aggravation, the time. But it would be pretty cool. One day I'd like to just like maybe when I retire, rent an RV and travel all the states. There's so many states that I haven't seen.
It'd be really cool.
Trailer like a small car. So you get to where you are. And when you're in that city, you just drive that little car around or rent one, whatever. Who knows? Maybe there'll be robots or flying cars or skateboard. Who knows? But yeah, a lot will change. Speaking of gas prices, Biden aims for fewer new leases. So when you look at the Pacific Ocean, the drilling platforms and the leases and the permits and all that, he's still committed to this Green New Deal, this energy efficiency and clean energy. And with that, you're going to sacrifice something. And right now, unfortunately, it's the cost at the pump. By limiting the supply in these permits and whatnot, we're going to be paying for that at the pump. But it's also in a way going to curb spending, right? So that will keep inflation in line. And the idea is you can't get both. People want higher interest rates, which I agree with, over time. And I think it should have happened before, not now. It should have happened before, so you have a mechanism to go backwards. Mm-hmm. But now they're complaining that rates started to fall a little bit. So when you look at the 10-year, it kind of fell in the last few days where rates are going down a little bit. And so the market's starting to shift both ways, and you can't have your cake and eat it too. You either want higher rates or lower rates. If rates are going up, they're trying to curb spending. If rates are going down, that means the economy is starting to slow and things are actually working. So it does have an impact on commodities, does have an impact on the dollar, and we're seeing that now, a very strong dollar. So if you're traveling that's abroad, that's a good thing for you. But I think that's the latest and greatest from the Journal. I like the articles. There's some healthy eating tips in here. I guess I have to improve my eating habits. Haven't quite gotten there yet. It's about time management though, right?
That's pretty much what it is. Self-discipline.
That's right. I lack that. Thanks for crashing my hopes and dreams, Sam.
Anytime.
With that, I think that's all the time we have today. Thanks again for listening to PennyWise Financial Podcast. This is Constantine here at Monarch Wealth Management with my co-host, Sam Gueli. Thanks again for listening.
You've been listening to PennyWise Financial, brought to you by Monarch Wealth Management. Constantine and David really care about their clients. They want to make sure you're happy, so you'll continue to hire them. There's no commitments, and clients are free to leave whenever they want. Think about being able to pick up the phone and call someone for guidance and advice on almost anything, from buying a car, selling a home, buying vacation properties, or even selling a business. Reach out on the website at monarchwealthmanagement.com. There are 2 offices in Rochester and 2 offices in Buffalo. Reach out to us on Facebook, LinkedIn, Twitter, and YouTube, or call us toll-free at 800-480-1580. That's 800-480-1580. Until next time, this is PennyWise Financial, signing off.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA, and SIPC.